Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're sharing 3 stories. First, the stunning jobs report revealing 911,000 jobs never actually existed, and why JPMorgan CEO Jamie Dimon is now warning the economy is weakening. Second, we'll explore Google Cloud's massive $106 billion customer backlog, fueled by AI demand and a $10 billion contract poached from Meta. And third, the $53 billion merger creating a new copper superpower between Anglo, American and Teck resources, and why rivals like BHP could still crash the party. So the story that's shaking up markets today begins with a single massive correction. The US Labor Department has revealed that 911,000 jobs we thought were created through March of this year simply weren't. Now, how does a number that big just disappear? It's not a typo. You see, the initial job numbers you hear are just an estimate coming from a survey of about 121,000 businesses. What's often overlooked, however, is that the response rate to that survey has been falling, dropping from over 60% to under 50%. To fill those gaps, the government uses a statistical model, the birth-death model, to guess at job creation. This massive revision is what happens when those initial guesses collide with the hard data from state unemployment tax records, which arrive much later. A while back, we flagged this exact vulnerability when Governor Waller warned the official jobs data was masking weakness. Well, today's overhaul is that story landing in full. That jaw-dropping number prompted a stark warning from JPMorgan Chase CEO Jamie Dimon. His words, "I think the economy is weakening." His opinion carries so much weight because institutions like JPMorgan are becoming what some call a private Fed. By analysing millions of daily credit card transactions and payroll deposits, they get their own real-time economic dashboard, often weeks ahead of official government reports. So when Dimon speaks, he's not just guessing, he's looking at proprietary data that rivals official statistics. Remember, we've talked about how traditional reports are lagging indicators. This is that high-frequency edge in action. This wasn't just any adjustment. It was the single biggest downward revision to jobs data in more than 2 decades. It confirms the world's largest economy created far fewer jobs than we thought, but that's not the whole picture. The real turning point is when you look at the most recent data, this massive revision follows a report showing job growth slowed to a near halt in July, adding just 73,000 jobs. Then August came in even weaker, with a meager 22,000. This dramatic reversal comes just a month after the head of the Bureau of Labour Statistics was fired, hours after that weak July report was released. The core issue here is that federal statistical agencies are designed to be independent firewalls protected from political pressure. Their entire purpose is to provide objective, reliable data. When that independence is questioned, or when trust in the numbers erodes, it has massive consequences for everything from Federal Reserve policy to business investment. It mirrors the broader fight we've been tracking over central bank independence and why countries like Turkey and Argentina serve as cautionary tales. Dimon, whose bank sees this data firsthand, openly questioned if a recession is now on the table, stating, "Whether it's on the way to recession or just weakening, I don't know." He even noted that while the Fed will probably cut its benchmark interest rate, the move might not be consequential to the economy. As we discussed, Governor Waller even opened the door to a larger half-point cut if conditions deteriorated. Today's revisions move that scenario closer. This brings us to a new era of economic intelligence. While government agencies work to modernise, the private sector is racing ahead. Hedge funds and banks are now using AI to analyse alternative data. We're talking satellite imagery of retail parking lots, real-time tracking of global shipping, even social media sentiment. So the future of understanding our economy is becoming faster, more complex, and happening in real time, creating an information advantage for those who can afford it. Now, shifting from that weakening economic picture to a pocket of explosive growth, Google just revealed it's sitting on a $106 billion backlog of customer demand for its cloud services. That's right, $106 billion. In the world of enterprise tech, a backlog isn't just a waiting list. It represents signed contracts and committed future spending. This figure is a massive, legally binding pipeline of future revenue. A while back, we talked about the flip side of this equation, AI labs racking up enormous cloud bills. OpenAI, for example, is a huge renter of compute from suppliers like Oracle and Google Cloud to avoid total dependence on Microsoft. that kind of demand is exactly what fills the supplier's backlog. And what's really brought this to a head is a statement from Google Cloud CEO Thomas Kurian, who says that backlog is growing even faster than their current revenue. More than half of it is expected to convert into revenue within just 2 years. For a company often seen as playing catch-up, Kurian flatly stated, "We've made billions using AI already." So how are they pulling this off? It's a three-pronged attack: consumption, subscriptions, and upselling. First, consumption. The pay-by-token model is a paradigm shift for businesses. For years, companies were used to predictable software subscriptions. Now, the cost of a critical AI tool can fluctuate wildly. This decision brings both flexibility for users and comes with inherent risks, creating a budgeting nightmare for finance chiefs who have to guess at usage. Second, subscriptions. Google is rolling out premium AI tiers like the new Google AI Ultra at $249 a month. The interesting part here is the question it raises about what higher quality AI really means. Is it just faster or more accurate? This creates a potential AI quality divide where the best performing, most truthful AI is only accessible to those who can afford it, leaving smaller businesses with lower quality models. And third, upselling. Kurian says once customers get a taste of Google's AI, they end up spending more. The strategy appears to be working. Here's where it gets interesting. Google just poached a $10 billion 6-year cloud contract from Meta, a company that has historically relied on Amazon. The backstory reveals Google's Trojan horse strategy. They're not just selling storage, they're luring massive enterprises with their specialized proprietary AI hardware, their tensor processing units, or TPUs, which competitors can't match. If that playbook sounds familiar, we noted a while back that OpenAI is pursuing its own custom chip strategy. Google already has its differentiator in production. The momentum is accelerating with a 28% growth in new customer wins in the first half of the year alone. However, if you zoom out, you'll see another layer to this story: the hidden environmental cost. The International Energy Agency estimates data centers and AI could soon rival the electricity consumption of Japan. Google's own greenhouse gas emissions have surged, and its data center electricity and water usage both jumped by 17% this year alone. So while the world watched the chatbot race, was the real war for AI dominance being won quietly in the cloud? Speaking of the incredible resources needed to power this AI boom, our next story is about the very metal that makes it all possible: copper. The second largest mining deal in history just dropped, forging a new global superpower between two titans, Anglo, American, and Teck resources, with a combined value over $53 billion. The key to understanding this deal is realizing that the demand for copper isn't just about construction anymore. The real driver is the explosion in AI. Believe it or not, an AI data center can use 3 to 5 times more copper per megawatt than a traditional one. By 2030, AI infrastructure alone could demand an extra 1 million metric tons of copper every year. So control the copper and you control a critical bottleneck for the entire AI revolution. But this isn't just a friendly handshake. This move is being called a strong defense because both companies have spent 2 years fighting off hostile takeovers from even bigger predators like BHP and Glencore. Now, they're teaming up. This is where the situation takes a more complex turn into geopolitics. The failed Glencore bid was from a Swiss company. This merger is between a UK and a Canadian company. For a country like Canada, which is serious about protecting its critical minerals, a merger with a partner from an allied nation is far more appealing. It helps create a secure, Western-aligned supply chain, putting it in direct competition with China's global strategy. The new entity, Anglo-Tec, will become the world's 5th largest copper company, projecting $800 million in annual savings. A huge part of this isn't just cutting jobs, it's about technology and geography. In Chile, both companies operate massive copper mines right next to each other. By merging, they can share infrastructure like water, power, and autonomous hauling routes. It's a huge efficiency gain. But here's the twist that has Wall Street buzzing. It's a zero premium deal billed as a merger of equals. Now, in high finance, that phrase can be a bit misleading. Anglo American shareholders will own 62% of the new company, and Anglo's CEO will run the show. Historically, deals with this kind of imbalance can face major culture clashes down the road. Analysts are saying this lack of a premium could open the door to rival bids, specifically naming BHP and Glencore as potential party crashers. To protect the deal, there's a $330 million break fee, and Anglo American is also sweetening the pot for its own shareholders with a $4.5 billion special dividend. This entire saga is playing out against the backdrop of a global race for critical resources. The question isn't just whether this deal gets approved. The real question is this the end of the fight or just the opening shot in a new global mining war?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.